This
That's a lovely
conference will
photo.
now be recorded.
Okay, good morning everybody and welcome to this webinar. I make that 9:30, so we shall get cracking this morning. It's a horrible rainy Tuesday morning which followed a very rainy Monday altogether, so I hope you enjoyed your bank holiday even if the weather was a bit adverse. What we can do as well today is make use of the chat box, so you'll see a speech bubble in the top right hand corner of your screen. Please feel free to put any questions that you may have in there and we'll get through those later on. And if you want to unmute yourself and ask some questions, please feel free to do so. Just shout out questions, stop me whenever you want and go through stuff. I'm happily do that. We've got a select group this morning and so we shouldn't have too many interruptions, but let's get cracking on. So first of all, I've got to read out our disclaimer, and the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. So today we're going to be looking at cash management and how cash is king in your business. We're going to look at cash flow. We're going to look at potential cost cutting, invoicing and collecting cash. And again, if you've got any questions, please feel free to stick them in the chat box. But just to get you going, what I'd like to do, as we try and do with this, is make it a bit more interactive. I want to ask you a question. And does your business have a cash flow forecast? And if so, is it written down? So if you've got a cash flow forecast and it's written down and you review it regularly, please put a yes in the chat box. And if you don't, just put a no in the chat box. I'd just be grateful of your replies just to see what sort of people, what sort of businesses are actually preparing cash flow forecasts and which aren't. So it's a yes if you're doing one, and it's a no if you don't do one. So far, we've had just the one reply. It's a few more. Yes, we've got a yes. Any more replies? Don't be shy. You can put it in the chat box. It's not going anywhere. I'm not going to read out names and name and shame anybody if you haven't done one. Great. You've got a current cash book, but not any sort of forecast. I mean, it is fairly common these days for businesses not to do some sort of planning, not to have some sort of cash flow forecast. But we just need to bear in mind that times are going to get tough, and we need to be able to ensure that you have enough cash flow to ensure your business can survive going forward. And we'll come on to that in a bit more detail a bit later on. So let's look at cash management. And one of the things we want to look at is, do you know your numbers? Do you have up-to-date information? Do you have management accounts? Do you have access to that sort of information? Because without that, it's going to be very difficult to forecast any sort of cash flow. So what we need to do is ensure you do have some information to be able to prepare a cash flow in the first place. It's all very well you coming to us and saying, right, how have I got on over the last 12 months? But really, that's just very much historical information and it's very much out of date. It could well be that it's 12 months out of date, it could be 9 months out of date, depending on when your year end falls. So we're really looking at getting up-to-date information, and more about that later. Do you know your customers? Do you understand your customers? Do you know that when they're going to pay? Do you understand their credit terms, never mind your own credit terms? Do you have a tough times checklist? And what we mean by a tough times checklist is, do you review your budgets and set realistic and achievable targets for the next financial year? Have you actually considered that you can get rid of the can't pay and won't pay customers? I'm sure we've all got plenty of those who, for whatever reason, will delay the payment to you and will come up with any excuse not to pay. How often do you review your debtors list and chase up your overdue invoices? More about that in a minute. This is all part of your tough times checklist. Do you offer existing debtors extended payment terms and or discounts? If you offer discounts, it may be an incentive for them to pay their invoice sooner rather than later. How explicit do you make your terms of business to your customers? Is it all hidden in the fine print on the back page of an invoice, along with all the other T's and C's, or do you make it front and center in bold on the front of your invoices? So it means that people will understand when you're expecting to get paid. If possible, do you assign responsibility to one individual for invoicing and collections? So I know it can be very time consuming to spend a lot of time chasing up debts, trying to collect the money in. Have you thought of outsourcing that or giving that to somebody else so they can get on with it while you carry on running your business? And do you agree extended payment terms with suppliers in advance? So don't forget, it's a two-way street here. You're looking at collecting your money in and also paying your money out. So have you negotiated with your suppliers? And if appropriate, have you reviewed your banking facilities and discussed your future needs with the bank? There's plenty of funding out there. It can be difficult to obtain, but I know we have a funder on our guest list today, and I'm sure he can help you if you need any help in getting any future funding. Those are the sort of things you also think about when times are actually tough. We've looked at risk assessing your customers. Do you actually do any risk assessing of your customers? Do you actually get credit referencing from all your customers? Potentially, do you insure your customers? There are companies out there, not many of them, but there are few, where if you're dealing with large numbers, it may well be worth your while insuring your customer against the debt. So if they do go bad, you're going to get most of your money back. Have you looked at your invoicing procedures? And we're going to have more of that later, along with cash collection. Do you know your profitability by product or service? And again, we're not looking at cash here, we're looking at profit, but profit will eventually turn into cash. So potentially, if you have something which is not making a profit, it could end up being a drain on your cash resources. Much the same as, do you know your break-even analysis? Do you have a break-even point for where you know you're actually going to start making some profit? And then we come on to the using the government money wisely. So we've had the end of bounce back loans and Sybil's loans. A lot of people are sitting in that on that cash. And you want to use it very carefully because those have now gone. We now have the recovery loan scheme, and more about that later. So cash is king. In most businesses, it's all very well people talking about turnover, but the old adage always applies. Turnover is vanity and profit is sanity. So it's vital to hold on to as much profit as you can, because that in turn will form the basis of your cash. However, there's often a number of things that can get in the way of your cash, and it's often overlooked because you can have staff issues. It may well be that you've got issues within your company, you take your eye off the ball in relation to cash, and you have to deal with staff and employment issues. Maybe you're dealing with furlough or bringing back people part-time, and it's all takes away your focus from the cash. You also be looking after your customers. You're going to be setting sales targets. So again, it's all taking your mind off what you ought to be looking at, which is the cash. Cash needs to be front and center when you're dealing with your business. Marketing strategy, you've got to have one of these now that we're coming out of lockdown. How are you going to get your new business? How are you going to market your business? You may have your own systems, in-house systems. There may be legislation which gets in the way of actually how you run your business and how you have to operate. You may well have to recruit. So you've got all these other distractions which can affect the way cash actually works within your business. So does cash come at the bottom of the list for you? And it can do with a lot of people, because you've got so many other things to deal with that cash often comes and gets overlooked, whereas it is the most important thing to enable you to run your business. Have a look at your processes to see where cash is tied up. And we're going to look at that in a second. Can you improve these? Can you change the way you work? There's a book on screen there called Who Moved My Cheese? Some of you will no doubt have read it. It's a wonderful short book. It will take you about an hour, hour and a half to read, and it's all about change. We're all businesses are going through change at the moment with lockdown and coming out of lockdown. You can get this off Amazon. It's only a few pounds. We've actually given this out to clients in the past, and it's all to do with how to embrace change and dealing with change within your business. And you can give it to your staff because there's going to be plenty of changes happening. So get yourself onto Amazon, download that, and give it out to friends, family, customers, suppliers, and so on, because it's an excellent book. Then have a look at doing a cash flow forecast, and we'll explain how to do that in a minute. And when you do a cash flow forecast, you need to do one monthly as an absolute minimum. In the past, I've done cash flow forecasts for clients on a daily basis. So we've literally got the days of the month across the top of a spreadsheet, and the expenses are all, and income and expenses are all filled in from that. When times get tough, you need to keep on top of your cash, and it needs to be updated regularly. Main advantage of doing that is if you have a monthly cash flow forecast and daily one going forward for say 3 to 6 months, you can identify where those holes are appearing, and then you give you an opportunity to be able to deal with it. Don't expect that you suddenly do a cash flow and you realize next month you're going to run out of money, or you're going to go over the overdraft facility and the bank will be able to arrange something for you straight away. It simply isn't going to work that these days. You need to have a few months in advance to know that you're going over your facilities, or you need some extended credit so you can actually do something about it. So let's have a look at this as an example, and we look at this and say, right, this sales can be £50, it could be 500, it could be 50,000. So we think, great, we're making sales of 50,000. We've got direct costs of 15, we've got wages of 15, and we've got overheads of 10. So therefore, we're making a profit of 10,000, 100,000, whatever that is. So we're knocking off some tax, we're putting some money aside for the tax man, always a useful exercise so that you can have the money when you need it. So you've got a net profit of 8. That's per month. On a quarter, you're thinking, great, I've made £24,000 worth of profit. Sounds great, doesn't it? However, where has the money gone? You're probably thinking, well, I haven't got 24,000 in my bank account, so where is it? It could well be that some of your money is tied up in your stock. The money can be tied up in your debtors, so the people are actually owing you money. Your cash collection isn't good enough. Your stock holding, you're holding perhaps too much stock. The overdraft facility is up to £60,000. You've got VAT due and you've got corporation tax due. So you end up with net assets. That's where your profit is of the £24,000. But none of it is actually in cash, because it's all held up in various different areas. It's held up in stock, which is stock you've bought. That may well convert into cash of maybe £25,000. You've not collected in your money, and therefore your overdraft is up there, and you owe the VAT man, and you're putting money aside for the corporation tax. So there's a lot of sticking points within there. So if we look at these cash sticking points, it's debtor timings. It can be stock holding. So if you've got stock and it takes you a long time to convert that stock into an invoice, and then takes time to convert that invoice into cash, that's where your sticking point can be. It can be the time it takes to convert that stock into work in progress and into that final product which you're actually selling. It can be your supplier payment terms, and it can be creditor timings. So let's have a look at this in a little bit more detail. So for instance, you buy your raw materials and it's cash on delivery, COD, is cash on delivery. So you don't get any supplier credit terms. It then takes you 30 days to produce that product. And you raise that sales invoice at the end of that 30-day period. and the debtor pays in 60 days. So you've now got a period of 120 days before you're actually going to get paid from the order first coming in. So let's look at seeing how we can actually improve those cash cycle timings. Well, let's look at negotiating better terms with our suppliers. So rather than paying cash on delivery, why not try and get 30 days terms from them? Or even 60 days terms or 45 days terms. Anything that you're going to get from your suppliers is going to help with your cash flow. We then look at our work in progress. It potentially takes us 30 days to produce our product. Is there anything we can do within our efficiency savings? So instead of taking 30 days, we can reduce that side down to maybe 20 days. And that's going to, again, give us a lot more ability to be able to manage our cash. So if we're getting 60 days from our suppliers and we're taking 20 days to produce the goods, we raise the sales invoice promptly. So you do it literally on delivery or even before delivery. Can we get any cash up front from our customers? And then you reduce your debtor timings from 60 days to maybe 30 days and make those your terms of business through better debt collection processes as well, and keeping on top of all the people who owe you money. If you can get it to a point where it's a pay when paid basis in effect, so you're taking your supplier payment terms to 60 days and you can match it with your debtors terms of 60 or your cash cycle timing of 60 days, you're in a far better position for managing your cash. So it's well worth having a look at all these different areas, literally buying your raw materials, looking at your work in progress, how you can produce their goods more efficiently, raising your sales invoices promptly, and looking at cash collection procedures. And we'll go into a little bit more later. We've talked about cash flow forecasts in the past, and it's something that you can do yourself. We'll happily do this for you. We do a number of cash flow forecasts for clients. It's something we produce on a regular basis, and I've got a lot of experience in dealing with these sort of things. So if you need any help with this, just give us a shout. But you need to consider the fact that you're dealing with money in and money out. So you're not dealing with your sales invoice, you're talking at the gross sales value. So if you're selling something for £100, you don't put £100 in your cash flow forecast, you're putting in 120 because you have to include the VAT. So you're dealing in money in and money out. You want to include loan repayments as well. And if you're starting to repay your Sybil's loans and your bounce back loans, you need to put those loan repayments in there. Have a look at when your tax payments are due. So that's corporation tax, or for your sole trader, your income tax bill, the self-assessment bill. Put in your VAT payments as well. So you need to work out the VAT payments that you will be including into your cash flow forecast. Exclude depreciation, which is something you normally see in your set of accounts because it's not a non-cash item, and any other non-cash items that are in there. And if in doubt, please ask us for help. This is a sample cash flow which we've put together. And as you can see, we know we've got sales receipts coming in for, say, the next few months. We've put in some speculative sales in for the next few months as well. We know what the cost of sales are likely to be for those going forward, and then we put in some speculative cost of sales figures as well. We know our central overheads for the next few months as well, so we can see there's a net cash inflow and there's a net cash outflow in red. We start with an opening balance, we work out, we put in the net cash movement, and it leaves us with the closing balance, which is great for, say, the November and December months. January, okay, we've gone over, but we know our overdraft facility is £250,000. We know that February we're going to have a problem because we're over by quite a substantial sum. So it's giving us 4 months, 4 to 5 months, depending on when you do this, to say, well, actually, we know we've got a hole in February where we're going over our overdraft facility or our banking covenants or whatever it is, we're breaching those facilities. So we need to do something about it. We know it turns around in March, and we know it turned and it will be back in positive in April and May. So what is it that we can actually do to actually improve the position in that February month? Well, as you can see, our sales receipts in February are significant. Is there any way of us moving those sales receipts and having better cash collection, or asking for payments up front in January, because those are fairly low, being the start of a new year? Could we shift some of that money back into January, reduce this overdrawn position here at February, and therefore we know things are going fine? Worst case scenario, we have to approach the bank and say, well, look, we need a temporary facility. It's going over in that month, but potentially we know it's going to be fine thereafter. So it gives us the option to be able to do that as well. So there's all sorts of things you can do as long as you've got time to be able to deal with that cash position. And remember, again, to include your VAT, corporation tax payments, loan payments, dividends that are in addition to normal overhead costs that you would see in your profit and loss account. So again, all these figures need to be included in your cash flow forecast. But again, if you've got any questions on this, please just give us a shout. So have a look again at cost reduction. Look at all the costs. Where times are hard, have a look at all the costs that you're incurring to see if there's anything that you can actually cut back. One thing you might want to consider is reviewing your direct debits and standing orders that are going out. It's something perhaps you should do on an annual basis, and to see, well, do I really need that direct debit or standing order? It's something that I do when I look at my personal bank account and say, well, a lot of all these direct debits and standing orders going out, do I really need the Amazon Prime, or do I really need the subscription to something else? Again, it's sort of things which you can review through the business as well, and to see whether it's worthwhile you continuing on. So look at cost reduction. Look at your utilities to see if there's a better way of paying for your utilities or getting cost reduction for your utilities. There's plenty of compare the market sites out there, see if there's any way of reducing your costs. Maybe also negotiating with your suppliers better terms. People are going to want your business at this time, so it may be an opportunity to actually negotiate better terms, and reducing margins, reducing costs by 1% will increase your margins by 1%. It can make a big difference over a year. Look at paying down debt. A lot of people have taken on the bounce back loans and the Sybil's loans, and they might have your 50 grand sitting in your bank account. And you're thinking, well, do I really need that? I've taken it because I wanted to take it just in case, which is what a lot of people have done. And there's an opportunity now to pay that back, because you're going to be starting to repay those loans over the next month or two. So do you really need that money? And if you do, then great, use it for something within the business. Don't do as I think a number of people have done and gone out and buy a nice new car or put it as a deposit on a holiday home or something like that. It has to be used for business purposes. But if you don't need it, you can just pay it back and there's no penalty. Look at any cheap debt that's out there, and we'll come on to the recovery loan scheme. Claim back everything that you can, and this is where we can help. So if you're not claiming everything through the business, or you're incurring some costs personally and you've just not thought about claiming for them, then again, claim for everything you can. But don't make your cuts too deep, because it may risk you not being able to produce what you're supposed to be producing, which can therefore affect your ability for future funding as well. Have you got surplus assets within the business, stuff which you're just not using, which has a value? Potentially look at selling those, raising some extra cash if you need to. And history has shown that companies with lower levels of debt do tend to survive better during times of crisis. Now, it's up to you to decide whether we think we're going into a big recession. Personally, I think because we're having a bit of a spending spree at the moment, and I think when furlough starts to end and when companies start to have to contribute, I think we'll see redundancies start to increase and recession therefore will hit. But that's my personal view. So we looked at cheap debt, and I've put cheap as an asterisk by it because we now have the recovery loan scheme, which was launched on the 6th of April, and you can still apply if you've had a bounce back loan or a Sybil's loan already. It runs to the end of this year and can be funded up to £10 million by either term loan, overdraft, invoice finance or asset finance. and you can borrow up to 250,000 or less, and there's no personal guarantees. And they can't hold personal guarantees over your principal private residence, PPR. However, the annual effective rate of interest and upfront fees and other fees cannot be more than 14.99%. That's the cap which we've put on it, which is significantly higher than the bounce back loans and the Sybil's loans, which were capped at 2.5%. So this looks like it's giving the banks the opportunity to start and charge a lot more than they used to on the old loans. So that's why, is it cheap? It may well be worth looking at other sources of finance as well. And I'm sure Steve Gomez, who's on this call from Amiga Finance, will be able to help you if you are looking for future funding. Again, just a quick reminder, repayments will have only just started. A lot of people took out these loans in May and June last year. Build these into your cash flow forecast. So if you borrowed your 50,000, you've got 5 years now to repay it. So you're talking around about £900 a month that's going to go out of your cash flow, which is not insignificant. So do you have potential problems? Cloud accounting can be a key. It makes it a lot easier to monitor your statistics and use third-party reporting tools to enhance your understanding of the figures. If you do have some cloud accounting software, it means you've got up-to-date management information. That is always a necessity when it comes to determining the information that you're going to have to supply to the banks for the information that you need. So banks will often ask for cash flow forecasts, profit projections, up-to-date management accounts. If you don't have any sort of cloud accounting, or even if you're just using the desktop accounting, as long as that's up to date, that is fine. But what we need to do is make sure that we've got up-to-date management information, and cloud accounting is the key for that. If you want any further advice on cloud accounting, then please give us a shout and we can advise you on which is the best route to go down. The main ones out there being QuickBooks and Xero, and then we've got Sage as well, potentially more for your desktop than anything else. When you're looking at your debtors, do you actually profile your debtors and drill down to see the customers that might be in each category? So potentially what you can do is break down your debtors into very low risk, moderate risk, and then high risk, very high risk, and think, well, that's off the scale, or you're just not sure what it's all about. So it's well worth potentially kind of itemizing your customers and highlighting them in this particular way. Then you can see how much of your cash is potentially at risk. And then those are the sort of customers you want to keep on top of on a much more regular basis. So you're looking at your high risk customers and you're seeing that you've got £12,000 worth of high risk customers there and £6,000 worth of very high risk and 1,500 quid you're not sure about. You've got potentially nearly £20,000 worth of money there, which can make a massive difference, which is a great deal of risk. Not to say you've got to ignore these customers here, which are moderate, low and very low, but what are you doing about your high risk customers? Have you identified them? Have you thought about monitoring your customers as well with auto alerts? So does your system trigger email based on figures in the accounts when certain criteria are met? So for instance, when your debtor exceeds a certain amount, does it automatically trigger an alert to you? If your bank balance falls below a certain amount, does your system alert you to that fact? Are there any other key indicators you want to measure? So you can effectively build a system that is specific for you. And again, if you insure your debts, it can be very, very useful, especially this time where potentially there's a lot of customers out there who may be struggling. If you can get insurance on them, it's well worth having. It can be expensive, so it's not for all businesses, but it's certainly something to consider. Get the bills out. Something we've talked about already is invoicing on a very prompt basis. So think electronic and maybe ban paper. Invoice regularly, it reduces the work in progress. So don't think if you invoice, I'll invoice everything at the end of the week, or I send all my invoices out on the 20th of the month. Don't do that. Invoice when the job is done, or invoice in advance, and do it from your accounting software to save the paper. And also it saves postage as well. Automatic emailing of recurring monthly invoices can be done. It happens when you've got a mobile phone. They automatically email you your mobile phone bill. Why can't you do the same thing if you're operating some sort of subscription service, or you've got something which you're billing on a regular basis, maybe a retainer for work to be done? Get the bill out automatically from your accounting software. You can transfer those invoices directly into your customer's software. We use Dex, which used to be Receipt Bank, and we can get our suppliers to invoices directly into our accounting software, as our clients do as well. It is something for you to consider as well. This sort of thing is not expensive and is easily available at the moment, and it just saves time. So you're not sending out your invoice by post, waiting for it to be processed at the other end, and therefore there's a prospect and there's the ability for your customer to build into delays into the system. If you can email your invoice directly into their software, it's there and it's ready, and you can prove they've actually had it. So stop using stale mail and get your invoices and your bills out quickly. Call this one Chase the Laggards. So automate the debt chasing facility. Make sure your accounting software does this. A lot of it does. If you don't, make sure you review everything at the end of each week, and make sure the emails go out at the end of each week. If your terms are 30 days, make sure you send a reminder out maybe 10 days before the 30-day period is up to say your invoice is becoming due at the end of the month. Please make sure you'll pay it. And then after the 30-day period, if they've not sent it within the 7 days, you send them a reminder to say you're now overdue by 7 days, and so the process goes on. And you're sending out invoices and statements and reminders on a regular basis. I've called this one, sorry, we don't take credit cards, because you've got to make it as easy as possible for your clients to pay you. So accept money any way that you can. Any business these days can accept credit cards quickly and easily. You can pay now with an app on your phone. It's linked to Stripe. There are card devices out there called iZettle. There's PayPal, there's Square, which is another one. You've got to make it as easy as possible for your customers to pay you. So the fact that you don't take credit cards can potentially mean that you've got a further delay in your cash collection system. There's plenty of systems out there. They're relatively inexpensive these days. And even if you go to your local market store, sometimes on a market day, they're using these sorts of payment devices at the moment as well. And it makes life a lot easier to get your cash in quickly. If you need money now and you're in a position whereby you suddenly find yourself, actually, we do need some money very quickly. The old way was to invoice factoring or invoice discounting with some of the main banks. There now can be selective debt funding, and cash can become available within 24 hours. So you don't have to put all your sales invoices through a debt factoring company. It can be put through, you can put a single invoice through and just collect the money in on that one big single invoice, and that can make a big difference to you. So maybe you've got a big one-off project which you're about to deliver, and you know you've got to wait 60 days, you've not been able to get credit terms. You can get selective finance on one particular invoice. It's worthwhile having a look at. Obviously that there are costs involved, but it's something that is, if it significantly affects your business, it's well worth looking at and considering. Have you even thought of changing banks? There's a lot of challenger banks out there changing the ways of working. So we've got the likes of Starling Bank and Tide Bank, who are all online accounts only, but very efficient. Accounts can be set up very quickly. There are foreign currency accounts with high exchange rate charges. You've got Revolut, which is a multi-currency business account, lets you hold and receive and exchange in 24 currencies using the real interbank exchange rate. So you're getting faster transfers, with 0 fees. So there's plenty of new facilities out there rather than traditional going to the bank and getting a facility directly from the bank. Get rid of your petty cash. You don't want to be hanging around with petty cash receipts and dealing with a few pounds here and a few quid there. There are plenty of petty cash cards out there and prepaid debit cards. You've got the likes of Pleo, Soldo, where you can set up an automatic top up. So if the balance falls below, say, £30, you can top it up to £75. Your team can take photo of the expenses, send it into the accounting software, so you don't have to do any more petty cash analysis or accounts postings or so on. Make life easier for you when you're using your petty cash and to try and not have petty cash cards, petty cash accounts floating around, so you've not got people wandering around with cash. So, in summary, where we're at is you want to plan ahead to control and predict your cash flow shortage before it happens. You want to make sure that there's no hole going forward, which we've had a look at in your cash flow forecast. You need to understand where your cash gets stuck within the business. So review all that cash cycle, which we looked at. Think of your KPIs you should be reviewing to measure the efficiency of your cash lockup. So we'll have a look at your stock holding, have a look at your debtor days, have a look at your creditor days, and see if you can improve those to ensure you're generating more cash within your business. Review your controls and procedures to gain timing efficiency to make sure that you get the cash coming into the business. Look at your cash collection procedures and make sure that you're following up on old debts, profiling your debtors, making sure that you can actually get that money in quickly and efficiently. And have this cash flow forecast and keep reviewing it and making sure it's all there and up to date. I would say you want to review that on at least a weekly basis to ensure you've got the right cash and you know what's coming in. So that's in summary today's webinar on cash management. Anybody got any questions they want to raise before I quickly move on to our up and coming webinars? Feel free to unmute yourself if you want to. Just shout out a question. Make use of the chat box. Let me see if we've got any in the chat box. No, we haven't got any questions in the chat box at the moment.
Steve, not so much a question. Just one thing which I might have missed in your commentary regarding the bounce back loans. I know they're coming up to be repaid, and as you say, that can that needs to be factored into everything going forward. There should be an offer from every one of the bounce back loan providers to the business for them to extend that from the current 6-year period out to 10. Whether I missed that or not, but that's worth highlighting. If you know, if they want to keep cash in, it will cost a bit more in interest, but it will certainly reduce those payments over the short term. And if things come good in a year or two, they can pay it off, as you said, without any detriment anyway. That's right, yes, but they can't do that with the Sybils, though, can they? They can't extend the term at the moment. No, only the bounce back up to the 10 years. That's right. So yeah, it's worthwhile noting that if you are struggling to pay that back within the 5-year period, you can extend it to the 10. I'm not sure why they didn't do it with the Sybils. Any ideas from your side? Have you had any feedback from the banks? No, not at all. I think most of the bounce back loans were done through the banks, so they've got a bit more flexibility. Most of the Sybils were done through alternative funders, and they're just not as generous. Is a best guess for you, Steve. Okay, thank you very much for that. Any other questions or comments? Anybody want to chip in with anything? Okay, what I'd like to show you is over the next few weeks, this obviously session is being recorded, will go up on our YouTube channel later on today. And if you've missed any of our previous webinars, they're all up on YouTube. Just go to Harts Limited and you'll see them there, and you can catch up on anything that you've missed. Our next one is the 18th of May, and this is our first ever Harts Question Time, where we have, our panel will be David Rutley, MP for Macclesfield. We have Sandeep Renault, who is also a professor of mental health, as well as a consultant paediatrician psychiatrist.
We have Rob Smethurst, who's the director of Macclesfield Football Club, the old Macclesfield Town Football Club. And we have Sue Bone, the CEO of North Cheshire Chamber of Commerce. So this is the first time we've actually had a Harts question time, and it'd be great if you want to pull in your questions. Let us have them by the 14th of May, so you can put them to our panel. And that session will not be recorded. It's going to be a live session only. Then on the 8th of June, we are talking about grants and what grants are available to you, how to access these grants and so on. And this is going to be our guest speaker is Karen Taylor, who is the group head of grants at CATAX. And on the 22nd of June, I'll be presenting a session on the key drivers to business growth, which hopefully you'll be joining us from there. But I look forward to seeing you all on the 18th of May. Please spread the word on that one. It's all for free. We'd love to see you on that, and we'd love to hear from you and see what questions you want to put to our panel. Unless there's anybody else wants to raise, I want to say thank you all for joining us this morning, and I look forward to seeing you all on the 18th of May. Have a great day.